So for the second year in a row, more funds, hedge funds, I should say, liquidated than were launched. That's 2009. And of those that survived, the top most funds managed triple-digit performance gains, in some cases a 100% return. That's according to a new report on hedge fund performance coming out. And we're joined by one of the authors of that report. Ken Heinz joins us, president of Hedge Fund Research. It's interesting because we're now finally seeing this year more funds born than are dying here. Talk to us about the turn in that trend and when you first saw it.
Absolutely. It's been an amazing couple of years, certainly with the financial crisis and the recovery from the financial crisis in 2009. We saw more funds launched than liquidate in the latter part of the year, but as we said, for the full year, you still saw about 1,000 funds liquidate and just about 800 funds launch for 2009.
And what are we looking at this year? What you've seen so far? I mean, I hear so many people saying, I'm going to go out on my own, start my own hedge fund. Obviously, a lot of people leaving the big banks. And you hear less about people wrapping up hedge funds.
And I think that trend's likely to continue. Really, the peak level, and you can't, it's such a significant data point. Fourth quarter of 2008, you saw 775 funds liquidated in the quarter. And that was such a significant data point. That was really at the peak of the financial crisis, and since then it's the situation has steadily improved. Risk tolerance has come back into the market, and people are willing to put capital to work, and you're not looking at the capitulation that you were looking at then. I mean, I think that it's important that over the last 2 years, to say that there's been the crisis and there's been the recovery, but the reality is the industry is also transformed in some significant structural ways, and those are some of the things that we really try to capture in the report.
What I also thought was interesting in your report, Ken, was you talked about the biggest gaps between the best and the worst funds. We've seen that, widen?
Yeah, absolutely. It was we thought it was wide in 2008 when the worst 10% of all funds in the composite lost 62.4%, and the best gained nearly over 40%. The reality is it was actually wider in 2009. The top 10% of all funds gained an average of 100%, whereas the bottom 10% lost 16.5%. So it was really an amazing 116-point difference between the top 10% and the bottom 10% in our broad-based composite.
Why do you think that is? I mean, why did you see that spread out?
You know, it's really tough to say. I think that overall, the environment in 2009 was something of fat tails, where the funds that did the best were the ones that were positioned not by June, but the ones that were positioned advantageously at this time last year at the market bottom, and the people that were increasing their exposure at those very difficult times, those are the people that by the end of the year had produced the largest gains. In addition to that, it's really a testament to the magnitude of the dislocations which were apparent, particularly in arbitrage strategies. The capitulation was so intense into the end of the year that the pricing dislocations were very, very significant. And as those have narrowed in the last 14 months, you've seen consistently strong performance, in some cases very extremely large gains in some cases.
You know, Ken, I'm just back from Florida. Common Fund hosts a big investment conference, if you will. One of the panels that I moderated was called The End of Leverage. And a lot of folks, you know, what the implications are for investors. I'm just curious, when it comes to leverage and hedge funds, what are we seeing? We've seen it pull back, obviously, a lot post this crisis.
Absolutely. And we have seen funds applying lower leverage. In fact, we have the leverage data we have shows that 40% of all funds typically don't employ leverage on the long side, meaning for $100 million of capital, they even have less than $100 million invested on the long side. And then most of the industry actually falls in between 1 and 2 times leverage. That would mean for $100 million in capital, they have between $100 and $200 million on the long side. And we believe these numbers are lower than they may have been even 2 years ago, but certainly 5 years ago. And that's also a function of the volatility of the underlying assets. They've been significantly more volatile and require a lot less leverage in order to generate returns in the last year.
Another structural change is fees. They've obviously come down because investors can demand it. Is that why? I mean, after the death of so many funds?
It's very interesting that we continue to see this as well. Most of that has actually occurred with regard to the incentive. I think the standard acceptance of 2 and 20 as the model for everybody is not the standard right now. And again, the average management fee is closer to 1.5. There's some 2, some charge 1.5. But the more change we've actually seen is with regard to the incentive fees. On average, these have come down to around 19.2. But all the funds that launched in 2009, the average is actually 17.5.
Thanks, Ken. Got to wrap it up. Ken Heinz from Hedge Fund Research. We're back.